My name is Nick Vandersky. I'm a Vice President at Morningstar in our Advisor Software division. Morningstar recently forged a relationship with PriceMetrix to offer our pricing intelligence information through Advisor Workstation, which is our investment planning solution for advisors. The purpose of today's call is to shed some light on transitioning to a fee-based business. To help do that, we're providing some industry data from PriceMetrix, and we're also going to hear from a broker-dealer and an advisor team who've seen some dramatic shift in their business over the last few years. Our panelists for the call today include Pat Kennedy, the co-founder of PriceMetrix, Chris Russell, the Senior VP and Director of Business Development at Hilliard Lyons, and Tricia Hollander-Henning and Terry Hollander-Albin, who are both financial consultants with the Hollander Group at Hilliard Lyons. We'll start out with Pat Kennedy discussing PriceMetrix findings, then turn it over to Chris, Trish, and Terry, who will talk to us about how their firm handled transitioning to fee, as well as share a case study from advisors who embarked upon a transition and who have been very successful at it. In terms of logistics, if you have questions during the presentation, please type in the Q&A box on your WebEx screen. You should see it at the right-hand panel, and make sure to send it to all panelists. That way the panelists will be able to see your questions, and we'll address some of these as time allows at the end of the session. So to start off, let me introduce Pat Kennedy. He's the co-founder of PriceMetrix and currently leads the team responsible for product planning and strategy. He also spearheads most of the research and analytics that PriceMetrix publishes periodically. Welcome, Pat, and thanks for joining us.
Well, thank you as well, Nick. It's an absolute pleasure to be here and team up with Morningstar on this important topic, obviously based on the response to the session, one that's on the mind of a lot of financial professionals. So I'm going to cover three topics today. What's happening in the industry. We'll look at the economic impact on advisors who've made the change. And I'll share some of the influences on and the importance of pricing. A quick introduction to PriceMetrix. Our firm is all about data. To help you understand the source of the information I'm going to share, we collect data directly from the back offices of our clients. So we have a granular and comprehensive view of today 35,000 advisor books. We know what advisors are doing, how they're changing, what they're selling, and what they're charging. And we collect this data in the course of delivering 3 practice management software products, but we will from time to time publish research based on our data. Here are a few examples of some recent studies. Quite a range in topics, but a consistent theme is that we seek to understand the behaviors that lead to success. So today I'm going to share with you some highlights from 2 studies we've done. One is called Transitioning to Fee, just came out this summer. And the second is some highlights from a 2011 study called Fee and Managed Asset Pricing. So what's happening in the industry? Well, it shouldn't come as too much of a surprise that we are in the midst of a steady and deliberate transition to a fee-based model. From 2009 to 2012, assets in fee and managed programs have risen from 21% to 28%. When you dig through the average, though, you see a wide array of advisor behaviors. As you'd expect, when you consider the overall market shift, most advisors, almost 70%, have increased their percentage of fee assets. And about 21% have increased that percentage by at least 10% over that 3-year time period. When you look at the typical advisor, again, you see an incredible range in fee-based asset percentage, so the percentage of assets in fee programs. 91% of advisors have at least one fee account in their business today. Interestingly, only 1% have more than 90% of their assets in fee programs. So if you're planning a transition, one of the lessons here is be realistic in your goals. If your goal is to abandon the commission-based business fully, you'll be the exception, not the norm. The fact is most advisors employ a mix of transactional and fee-based arrangements in their business. Average advisor today is now opening 14 new fee accounts per year. Again, you can use this to sort of set your expectations or benchmark how you're doing compared to your peers. That's up slightly from 12 in 2009. interesting, 70% of new fee accounts are from brand new relationships. I know many advisors defer the decision to transition because they're unsure how to approach existing clients. And to them, I'd say, start with your new clients. But remember, these are 70% maybe new relationships for one advisor, but they could have been existing relationships for another. So if you're not talking to your clients about fee programs, somebody else may be. The average fee-based account is 46% larger and generates 3 times more revenue than the average transactional account. Fee accounts are larger and they pay more. It's an attractive proposition, but bear in mind, we're not suggesting that when you transition a client, they will magically become larger and pay more. It may well be the case that those relationships are already larger or paying more, are the ones that are more likely to choose a fee-based arrangement. In fact, we would never suggest to an advisor to switch to fee just to get paid more. But that said, the transition represents an excellent opportunity to remind clients of just what they are paying for and the value that you're bringing to the relationship. So who's buying fee-based advice? Clients between 40 and 64 have the highest penetration of fee-based assets. Older clients have been a little bit less eager to adopt. Interesting, though, we also see lower penetration in younger clients. In some cases, it may be the case that younger clients don't have the assets to meet certain minimums required by fee programs, but even when you normalize for that, we see less preference for fee in that segment. So again, something for an advisor to think about as they prioritize their transition efforts. And the last trend I'll share is an increase in households that have both fee and transactional business. 1 in 8 households today are what we call hybrid households. And 1 in 8, you might think not huge, but consider that that number's grown by 41% in the past 3 years. And if you look at the green, it's the larger relationships that are holding both. So another thought for advisors, going fee may not mean abandoning the transactional model, and having that mindset may not be in line with your client's preferences. Next thing I'm going to talk about some advisors who made the change. One of the coolest things about our data set is that it's what we call longitudinal, which means we can track what happens to books over time. In this case, we looked specifically at advisors who made the transition, again, 2009 to 2012. We looked at 3 groups. Those that had really not transitioned at all. If they did, it was slight, so less than 10% change, and that would include those that hadn't changed at all, sort of the control group. Group 2, those who had increased their fee-based ratio moderately, 10 to 25%. And group 1, those that had transitioned a little bit more aggressively, smaller group, but those that had shifted their fee-based ratio by greater than 25%. If you look at group 1, those that transitioned aggressively, they outperformed their peers in terms of revenue growth, 47% over that 3-year period, compared to 31 and 21%. What I find particularly interesting is that group 1 also outperformed in terms of asset growth over that same period. I can't tell you how many advisors I've heard from who sort of feel like they need to put their business growth on hold while they transition their business. In fact, the results are just the opposite. Advisors who made the most rapid transition actually outperformed their peers in terms of asset growth. One of the things that advisors struggle with the most as they transition is, what's a fair fee to charge? And I wanted to review some of the findings of our 2011 fee pricing study to help shed some light on that. So what is it that influences fees? Certainly the overall relationship size has a big influence. Here you see household assets from low to high and the relative ROA or revenue on assets of fee programs. Red here is the firm's scheduled or recommended price. Most firms or many firms will default to a negotiated rate above $1 million. When you look specifically at relationships above $1 million, you see that same decline continue. And interesting here, one of the biggest myths you hear is that the new market acceptable rate for fee programs is 1%. In fact, when you look at the data, it's not until $3 million in household assets that the average ROA crosses below 1%. The fact is, investors are willing to pay above 1% for a quality advisor. Certainly our data suggests that. Asset mix also has a large influence on fees. Fairly crudely here, if you look at equity-focused households, they pay about 40% more than fixed income-focused households. So clearly asset size, portfolio mix have an influence on fees, but when you hold those constant, and a lot of our 2011 study did that, and look at the actual range in fees at the advisor level. So if we look here specifically at balanced accounts, so a mix of equity and fixed income, for a certain segment, 250 to 500K in household assets, you see really an incredible range in how advisors price fee accounts. I think that's one of the most important things for our listeners today to understand. I mean, you see high concentration certainly in the 1 to 1.5% range. We've got over 1/3 of advisors charging more than 1.5%. And remember, this is for similar accounts and similar households. So as much as asset size and portfolio composition may affect pricing, really it's the advisor that influences fees more than anything. The market will support many different price positionings in the advice business. Another question we get asked is it possible to raise your fee ROA? And the answer is sort of yes and no. What we observed in the study is it's very rare to see an increase in price for existing accounts. I mean, that makes sense. It's very difficult to negotiate up a percentage of assets. It happens about 5% of the time. That said, of the advisors in our universe, we saw over that time period almost 1/3 increase their fee ROA, but the focus there was on new accounts. So it is possible to do, and of course with 14 new accounts being opened per year, it doesn't take too long for a repricing initiative to have an impact on your book. Both of these points, by the way, speak to the importance of getting price right the first time when you're setting up a new relationship. Quick summary, the industry obviously continues its clear shift towards fee. Almost 70% of advisors are experiencing that shift, though the pace of transition varies. Our data tells us that advisors who most aggressively transition outperform their peers in terms of asset and revenue growth. Most new fee business is coming from brand new relationships, but again, that's brand new to the advisor, not necessarily brand new to the industry. Increasingly, households are using fee and transactional. Fee-based pricing is influenced by account size and account mix, but fees vary significantly from advisor to advisor. Rare to see advisors increase price in existing fee accounts, but many advisors have raised their fees with an emphasis on new business. So thanks for your attention, folks, and I will turn it back over to Nick.
Thanks, Pat. You always have great insights to share. I'd now like to turn it over to Chris Russell, who has led the charge for a transition from commission to fee at Hilliard Lyons. As many of you guys may know, Hilliard Lyons is a premium, full-service financial services firm with over 400 advisors across 70 offices in 12 Midwestern and Southern states. So, Chris, can you tell us a little bit about what you're doing with regard to the fee transition at Hilliard Lyons?
Well, thank you very much, Nick. I appreciate that. And why don't we just go ahead and start right off the bat with that phrase, transition to fee. At Hilliard Lyons, it's probably not the reality, transition to fee, and that's probably similar, supports the data that PriceMetrix showed. And I'll cover that a little bit further. Before I do, Hilliard Lyons, we have about 400 advisors, states going up to Michigan, down to Georgia, from Missouri to the Carolinas. But you should know that Hilliard Lyons, as a regional broker-dealer, we don't push our advisors to a certain business model. We are very much, with only 400 advisors, we very much take a hands-on approach. And I could probably tell you the business model of almost every advisor we have. But more importantly, I could probably tell you what they're trying to accomplish as well. And so what we mainly try to focus on is who's trying to transition or who's trying to move their business a certain direction and make sure we allocate the resources there. And typically that involves us going in the field, working with them side by side, meeting with clients if we have to, if that's what they would prefer. And so we very much so do that with our advisors that are looking to transition. And I will say, for the most part, we have seen an increase over the past several years of advisors looking to incorporate more fee-based pricing into their business. But let me go back, and I do want to touch on transition to fee as a phrase, because at Hilliard Lyons, Jeannie Oster, who actually runs our fee-based programs, has really touched on the fact that transition to fee is oftentimes can be perceived as a negative by the advisors. And so oftentimes it's not a transition from all of your business and completely overnight into a whole new business model. Typically, it is incorporating fee-based pricing to some of your clients where it makes sense and where it's appropriate. And so that's what we've kind of done is said, okay, Mr. and Ms. FC, which clients does this make sense for? Which programs then would make sense based on the investment process and philosophy that you have, and match that up and support that process. So when you hear transition to fee, that can be sometimes a scary phrase to hear, and it makes you feel, if you're an advisor, that you have to change everything overnight, and that's oftentimes never the case. Most advisors are taking baby steps, walking into this, and so that's really what's happening right now. What I would like to do, however, is introduce a couple of our advisors who did aggressively transition, and they did so early on. I will also highlight a point that Pat made. He said FCs who aggressively transition typically outperform their peers. I would say that the Hollander group who introduced do that, have done that, and probably because they did aggressively transition at the beginning the business. So let me go ahead and let them tell their story about how they transitioned their business. I know we have a slide that kind of shows, gives you a visual that you can see. Before I do introduce them, I'll show you that this chart that you're looking at will show you over the last 5.5 years. There's a blue line that tracks the assets, percentage of assets under fee and managed assets. You can see how that spikes up and goes from about 8 to roughly 40% in a very short time. The other number is revenue, and I think it's really important to see how the revenue didn't drop, which is also something that advisors typically fear, is a huge drop in revenue by moving aggressively to fee. So there's a lot more than the numbers, and that's the story that the Hollanders will tell. We have Terry and Trish Hollander, who are a pleasure to work with and a pleasure to support. They are professionals. They've got their CFP. I know they're working on their SEMA, and I think, Trish, you may actually already have or have just gotten your SEMA, so congratulations on that. Very successful, one of our top advisors here. So with that, I do want to go ahead and turn the call over to Terry and Trish Hollander.
Thanks, Chris. We are a team of 6. We're actually a family business. So there's 3 wealth managers in our team, our father, Ron, and then Terry and I are sisters. We have 3 support staff on our team. So we have 2 registered CSAs. They handle all of the client questions that are non-investment related. And then we have 1 CSA on our team who handles the marketing. As Chris said, we're both CFPs. Terry actually has officially completed her SEMA. I've passed my exam. I'm in the final stages of that completion process, and that's been a good, long process. We actually started transitioning back in 2006. And for us as a team, we were looking for a way to be more comprehensive and to sort of change the conversations with our clients that we were having. We knew we wanted to, we were very successful with a $500,000 and $600,000 rollover client, but we were at that point in our careers where we wanted to move to the $1 to $5 million space. And we knew if we wanted to do that, that we needed to be comprehensive. And in all of our research and in educating ourselves, we realized that in order to do that, we needed to be able to play in that fee-based world. So we started out by simply educating ourselves. We spent a lot of time with Chris and Jeannie and our home office staff, just learning about the different platforms that our firm offers. So we were prepared with the different options. And we committed 100%, and we will both tell you we think that's very important. we agreed as a team that every new client that came into our practice was going to use a fee-based model, and that we were going to work on existing clients, move to a fee-based model, and start a whole new conversation with those clients. So we felt by committing 100% and moving towards that change that we would be able to provide more advisory services that clients were looking for.
So we started by, on the existing clients, we really began with a new process and having a different conversation than we really had with clients. Instead of calling them with something that we wanted to do from an investment standpoint, we had our assistants set up review meetings with clients. And we had these meetings all day, every day, really. We really worked to sit down with folks and basically start off with telling us what's new with you. Let's talk about, tell us about your kids, your grandkids, your goals, your transitions that you're going through. We didn't start with any conversation at all about accounts. We listened to them. We asked them what they were worried about. We asked them what they want their money to do for them, where they hope to be. And at the end of that discovery conversation, we then said something like, because of what you've told us. So they might have been all in individual equities, and they might have told us, we're living on income and we want this to last and we want it to do something for our kids. We would then say, because of what you've told us, we see some changes that need to happen to your allocation. We need to add more diversification, perhaps. We need to make you more conservative. And so we then suggested that we would come back to them with a recommendation on what we thought was appropriate for them, and that we also felt like we needed to shift our relationship with them and start working with them where we could manage their portfolio so that we could have these kinds of conversations with them instead of a conversation about should we buy Bristol-Myers and sell Coca-Cola. And they really got that. I think we could tell that they liked that. It was taking some burden of responsibility off of them where they would just otherwise, yes, because that's what you're suggesting, we're agreeing, but because they had to agree to it, it made them feel like they were responsible for it, and they liked the idea of putting that responsibility back on us. So we explained how fee-based worked. And we didn't call it fee-based, of course. We explained how an advisory arrangement worked. We explained that we were going to meet with them ongoing on a regular basis and talk about them, not as much about their accounts. And they reacted very well to that.
Yeah. There was very, very little conversation about fee or the actual fee structure, and that is probably the part that amazed us the most. When it was full disclosure, we would have the fee schedule there, we would walk through how it worked. 99.9% of the time, the client would look at us and say, okay, now when can we get started on the whole planning part? And when can we talk about, do we need to bring in an attorney for our estate documents? And when can we talk about all of that other stuff? So we were a little bit concerned, as I think most are, about how to overcome the hurdle of the fee, but we learned very early on that the hurdle, if you will, of the fee was really in our own minds. It was not in the client's mind. The client looked at it as, in some cases, frankly, the client looked at us and said, well, my sister's been doing it for years this way over at XYZ. How come it's taking you so long to tell me about this? So that's the other part we learned, that if you're not talking about it and offering the opportunity for a more overall comprehensive management relationship, somebody else probably is. So we found that it helped us build deeper relationships with clients, and we now, frankly, are becoming the quarterback. It's allowed us to move into that $1 to $5 to $10 to $20 million space. we find ourselves more and more as the quarterback of the relationship. We're the ones that more and more are convening the people to discuss what needs to be discussed and pulling in the appropriate people at the right times.
So we did learn a few things. We started off, I would say, using a more canned approach, mutual fund advisory for most conversations. We very quickly learned that, the $750,000 person and above really needed a much more customized approach, so we branched out into other platforms that were offered by our firm. And that kind of went along with that whole education process of ourselves. As we had these conversations more and more, we understood and more comfortable with what fit where. From a business standpoint, assets and revenue really determine the level of customization for us. We can't offer everything to everybody, and so the level of asset and revenue really determines how much customization. But for our best clients, we customize not only the asset allocation, but everything about our relationship with them. We might help them with crummy letters. Like Tricia said, we're the quarterback. We do comprehensive financial planning. So incorporating all of that into the relationship, and their asset fee really covers those other services.
So all in at this stage in the game, our group is about 86% fee revenue. And we continue to work towards, as we mentioned earlier, that all new relationships are in that fee-based arena. We work very hard at branding ourselves as wealth managers and comprehensive, which of course then, in our opinion, helps support that overall fee, because that's the other thing ongoing. You have to be able to ongoing support that fee long term, so you have to continue to provide things that they may not get in other places. And we feel like it's allowed us to really, as we said earlier, focus on the $1 million and up clients more aggressively.
Well, thank you very much for that. I know we're going to have Q&A, or we actually have questions coming in, so I know we'll handle those. But I'll send it back to Nick. Before I do want to mention that one of the things that you touched on is basically around value and realizing your value, and that's a big component of how you make the transition in your all's own minds and justify the fee. And so we can talk more about that if the questions come in, but that's something that came up. Also, I do want to mention that at Hilliard-Lyons, what started out the fastest growing platforms was mutual fund advisory initially, and that was one that we saw take off pretty quickly because it's something that's familiar with advisors, and they understand mutual funds, they understand asset allocation, and that was an easy transition. Today, the fastest growing program for us is rep as portfolio manager, and that's where the FC, our advisors, have discretion. And so that's the fastest one today, and I think that's similar to what we see in the industry. So we may have questions, so I'm going to go ahead at this time. Thank you very much, Terry and Trish, and we'll send it back to Nick.
Thank you, Chris, and also Tricia and Terry. So we have time for just one or two questions. So the first one I'm actually going to give to you, Chris, and can you talk a little bit more about how PriceMetrix helped you transition to a fee-based model?
Yeah, absolutely. In fact, what I'll say now is Terry and Trish, because they're early adopters, they took it immediately and ran with it and probably figured a lot of this out on their own. Today, we do a lot for our advisors in trying to help them, and we partner with PriceMetrix tremendously on that. So a lot of it is, okay, PriceMetrix will identify your tiers, your households, the makeup, what are they invested in. And so if we're trying to help an advisor, and again, what I mentioned before is it's not a transition overnight of all clients to fee. What they do is they pick out certain segments of clients and figure out what your service model is going to be to those segment of clients, and that's where PriceMetrix comes in. In fact, a lot of success has come from advisors who are comfortable with mutual fund advisory, and they can pick out the segment of clients that fit, whether that's clients from 50 to 100,000, 100,000 to 250,000, whatever the case. But you can actually pick those clients out and identify the clients that have a high concentration of mutual funds who may understand that and make that transition easier. So PriceMetrix really lets the advisor take action because we can drill down in their book of business and pick out pieces and make that transition, again, baby steps, so it's not such a scary proposition for the advisor or the clients.
Thanks, Chris. So the last question I have is actually for Pat Kennedy. Pat, what mistakes have you seen people make when transitioning to a fee-based model?
Thanks, Nick. It's a great question, and I'll actually borrow from Terry and Tricia because what I heard, pardon me, and overwhelmingly from their discussion was two things: preparation and commitment. Both of those things probably kicked in after they had made a decision. I think one of the things that a lot of advisors overlook is when they're thinking about that model. Think about yourself as the CEO of a firm, and you're thinking about launching a new product. Before you decide to do it, it's okay to go out and listen to your market. Talk to your clients. You don't have to say I'm changing. You can say I'm thinking about this. Can you help me with that? Would there be an appetite for that? I think advisors sort of feel like it's the world is on their shoulders. They have to make a decision, and once they make that decision, there's no turning back. There's a fair amount that can go into informing that decision. I think many advisors could sort of tap in and listen to what the market is telling them. But absolutely, I mean, once you've made the decision, the characteristic that I think sets some folks apart from others, and a lot of the things that we saw today in terms of results are the two things that we heard from the Hollanders, which is do your homework and prepare and make the commitment, and I think that'll increase your odds of being in that aggressive transition group, and as the data shows us, that's where the greatest results have come from.
Thanks, Pat. And I'd like to thank all of our panelists. Actually, there's been a lot of interest and a lot of questions that have come in. We're actually going to close now just due to the sake of time. But I do want to note that we're going to be following up via email and actually providing three things in that email. One, we're going to provide a link to the full transitioning to fee report that Pat had mentioned earlier. We're also going to provide a link to the recording of this session in case you wanted to review it, and we'll also provide a copy of the slides so you'll have that. So again, really appreciate everyone's time today, and thanks again.